Welcome to Beyond Wealth, Success Unscripted with Matt Calnan. Discover the personal drive, professional journeys, and business strategies that have made a real impact. It's success from the inside out.
Welcome back to the show, everyone. Today we're chatting with Ben Reeves. Ben is an executive in the finance industry, leading the integration of software engineering, data science, and technology at Viewpoint Investment Partners. Over the past 7 years, Ben has driven the company to the forefront of applying quantitative and AI-empowered techniques to investment strategies, making institutional-grade portfolio management accessible to all. In addition, Ben is a founding director and chair of the board at the YYC Data Society, fostering Calgary's growth in the high-tech data sector. I'm happy I got through that. That was a tough one to get through, but Ben, do you want to start off by maybe telling us a little bit more about yourself and what you guys are doing?
Yeah, thanks, Matt. Thanks for the intro and thanks for having us here, or having me here, I should say. I don't typically introduce myself with the formal we, so that was a true gasp. Yeah, so for myself, at Viewpoint Investment Partners, we are a boutique investment management company based out of Calgary, trying to bring the types of investment strategies that are typically only accessible to pension funds, the ultra high net worth institutions, and we're trying to make those accessible to, Western Canada, Canada as a whole, and really everyone from, those, smaller institutions that maybe can access that premier style of investment strategy all the way to, our own parents and family. Right. I guess there's a little bit of a background from where our firm came from. So we actually did start from a highly successful family. So there was Mac Van Willigen was the founder of ARC Financial, which is a, very successful private equity company based here in Alberta, in Calgary. And the need for what Viewpoint does really came out of that family's experience post 2008, seeing how concentration in one industry, in the energy industry, really hurt in 2008, and how all of the hedge fund managers and investment advisors that they were paying high fees to provide that kind of protection ultimately didn't provide the level of service and the level of protection that they promised, and decided to take the asset management in-house. Our founder had been the chair of Alberta Investment Management Company, AIMCO, and so it's seen how institutional portfolios are crafted. That was the genesis of Viewpoint Investment Partners, was taking that need experienced by a single family and saying, hey, well, let's take this in-house and then bring it to the masses. So I started with the firm about a year after it launched, and I came as the engineering and the data science professional to the group. Whenever we started, it was just four of us in a small office here in downtown Calgary, and we had a Excel model, a financial model in Excel that was 5 gigabytes and crashed the computer when we tried to load it. And so I originally came on to turn that into a bespoke software solution. And since then, over the past 8 years, we've kind of turned that into an entire quantitative platform. We manage $500 million of assets right now through pooled funds and segregated accounts. And kind of coming from this as a perspective of, listen, we want to be globally diversified. We want to hold low cost, liquid ETFs and futures contracts, and we want to deliver, build incredibly efficient portfolios at low cost, and deliver that to everyone. So that's kind of where we are, a bit of the story of our firm, and kind of where my role sits.
Awesome. You likely didn't know this before joining me today, but I'm not a big fan of the financial industry, because I think it's quite predatory in nature, and particularly when you're at I'll call it the brick and mortar financial advisory type firms. There's mutual funds that have high fees on high fees, and I'm a big proponent of things like ETFs, of seg funds, of those. So
Matt,
And
I
you
know that you're about to ask a question, but I just want to interrupt you
go
because
ahead. Yeah.
I think this is a great story. So exactly what you said is what I said when I first sat in the boardroom for, I didn't know it was an interview at the time. But when I first sat in the boardroom with the rest of the guys, I said exactly that. I was like, listen, so I was working remotely in Tofino building software for big data oil and gas solutions, and I had my own side business. And I was just looking to do contract work with Viewpoint at the start. And I sat down, I was like, listen, I'll write code for you, but I want you to know that I think that the investment manager is extractive. I think that, people charge fees which are too high and they enrich themselves at the benefit or at the expense of the end client. And what was funny was, I 23, 24-year-old kid, cocksure, and thought that I was getting a good one in. And Rob, our CEO, is like, that's exactly what we felt as well. And that's why we started Viewpoint Investment Partners. So that kind of feeling or that experience is, that's a through line between my own experience, the family's experience, and now, of course, like our business.
Yeah, yeah, no, that's awesome, and I certainly applaud you guys for doing that and being, having that focus. For maybe those people that don't necessarily know what these are, can you just high level explain about ETFs and segregated funds or seg accounts? And I'll preface it by, you can't provide investment advice, and so if listeners want advice, then they need to reach out to an advisor and somebody that's licensed to do it. But yeah, maybe give the overall view of what an ETF is, what a segregated fund is, and maybe why those fee structures are so much lower.
Yeah, so Viewpoint, we run mutual fund trusts, which are we run mutual fund trusts, which actually typically hold low cost ETFs within those structures. So to explain that, you kind of have to go back to a revolution in how like financial markets operate that happened starting in the 2000s with Vanguard, who initially really pioneered this. And this is the story of ETFs and active management versus passive management. So originally, all investment was what probably like you think of, hey, the intelligent investor, Benjamin Graham and Warren Buffett, like, hey, identify quality companies and pick and invest in good businesses. And over time, they started to become stock indexes like the S&P 500, which I'm sure everybody here has heard of, the Dow Jones, the NASDAQ. And these are just collections, indexes of all of the different stocks that make up the market. And what people started to find was whenever you pay somebody to pick good businesses for you, you almost always perform worse than if you just were to invest in, if you've got $100 to put, $1 into each of the top 100 stocks in the US, for instance. It's a little bit more nuanced than that. It's based off of the actual market capitalization size, but you can think of, you've got $100, you invest $1 in each of the, top 100 stocks in the US. Yeah. And because you have all of these different market participants, people picking stocks, trying to figure out which is the best company, you wind up seeing that the largest companies are oftentimes the best performers. And as a result, these indexes, the S&P 500, typically outperform most actively managed stock picking portfolios. And then once you take fees and you charge, an advisor may charge 1.5%, they may have a performance fee, you may be paying fees on transactions, that just really adds up. And so, Vanguard especially started to notice like, well, what if you could just invest in the index itself? And so that's where, when I'm talking ETFs, I'm typically going to talk about, there's lots of different ETF products, but of the most interest, and without going too much into the weeds, talking about index funds, I think is the most best use of time for this. Yeah. And so, yeah, these ETFs, an exchange traded fund, it's a way for investors to buy a fund on public stock markets, the same way that you would buy, 100 shares of Apple, you could buy 100 shares of SPY. which is the ETF, which tracks the S&P 500 index. And so whenever you buy a unit of this ETF, this index fund, you put $100 in and you're going to get, a little bit of NVIDIA, a little bit of Amazon, a little bit of Apple, a little bit of Coca-Cola in proportion to how large those actual companies are in the market. And what you see is that becomes a really, really effective way to build a portfolio. It's incredibly simple. Simplicity is often parsimonious, and simplicity tends to work really well over long periods of time.
Yeah.
And so holding these low-cost ETF portfolios are a great way for most investors to have excellent financial outcomes without paying too much and doing it in a way that they can understand.
Yeah.
Maybe the last thing I'll say on that was there was a fairly famous, and one of the ideas that originally got me interested in financial markets was a famous bet that Warren Buffett made with, I can't remember who the counterparty was, but Warren Buffett said, listen, like, you pick the top 5 hedge funds, right, that are charging 2% management fee, 20% for performance fees, and I'll make an investment in a Vanguard low-cost S&P 500 ETF, and whoever has better performance after 5 years or however long it was will win $1 million.
Yeah.
And so the one guy picked the top, like the creme de la creme, the smartest guys on Wall Street, put a bunch of money into each of them, and of course, over 5 years, the old, boring S&P 500 index fund wound up outperforming.
Yeah. It's I can't remember the exact stat, but I believe it, because you mentioned it a couple times, of people just don't really beat the market. Advisors don't really beat the market. I think it's 4% is kind of over a long period of time. It's 4% of advisors will beat the market.
I'm not sure the stats on advisors. I know that and it's kind of different in different countries. So the US, there's different funds, and I think over 10 years, 80% of funds or 90% underperform their benchmarks. In Canada, it's a lot worse, actually. It's more like 95%, because we have a less competitive financial landscape. We have an oligopoly of large banks, and so typically Canadians are compared to our neighbors down south, Canadians are paying higher fees with fewer options, right?
Yeah, definitely. First of all, thanks for the overview of what those are, and I'm a massive proponent of those massive income strategies, because right off the bat you're probably 15 basis points, which is like 0.15% for those that don't know, like 0.15% to 0.25% maybe on the fees normally on those ETFs, versus when you're at an advisor level with a mutual fund. So whether maybe one of our big banks there, typically they are taking that 1.5% fee, but then the mutual fund is charging a 1.5% or 2% or 3% fee. So when you really dive down into those fees, sometimes you're paying 3-4%. How can that possibly then beat an ETF that's at 0.25%? But let's dive into the AI side of this, and really what your role is at the organization. What are you guys doing with AI that's making it more economical versus the active managed funds?
Yeah, so we take an approach of being active at the asset allocation at the global level. So, we get our exposure through ETFs. When we want to invest in the US market, we're not picking stocks within the US financial market. We're going to hold a ETF for the entire US market.
Yeah.
But most investors don't want to just hold the US market. They want to hold US stocks, they want to hold international equities, they want to hold fixed income, they want to get some bonds in there, both domestic as well as international. Commodities are an interesting asset class for a lot of investors. So, oil, gold, industrial metals, copper, talk about electrifying the grid, right? And then foreign exchange, right? So the question becomes, if you want to just hold the US stock market, you've got a great product, you have the S&P 500. If you want to hold the entire global market, things are a little bit more Well, I wouldn't say that there's not good product out there in ETF form. There certainly is. There's a lot of, Aquifer global equities. There's an Earth URTH ETF as well. So there's a lot of good kind of 60/40 VVAL, Vanguard balanced. There's a lot of great ETF products. But what we were interested in is how do we have a investment portfolio which is kind of globally diversified from a macroeconomic risk factor, right? So we want to have our portfolio be exposed to, interest rates in Japan, as well as, industrial production in China. And we want to have exposure to tech investment in the US. And that's really where we wanted to build a portfolio that was globally diversified and exposed to all of these different macroeconomic regimes. Everybody knows that inflation has been a painful part of existence over the past several years. How do you have an investment portfolio which performs well in an inflationary period, as well as, deflation or stagflation or disinflation?
Yeah.
And so that's where we are coming from like, how do we combine these different low cost ETFs into a single unified package that meets all of these different needs? And to do that, where the AI comes in, and we speak about it more in terms, between friends, we speak of more in terms of data science and statistics. Of course, there is like what people think of conventionally now as AI is a part of it. But there's lots of different pieces from, simple models all the way through to highly complex models. And it's largely about understanding risk. It's incredibly hard to predict returns, to use AI models, to use stats in order to predict what stocks or which asset classes are going to perform well in the future is incredibly difficult. I'm not saying
there's just there's just so many factors, right? So many outside factors that contribute to all of that.
Yeah, and you can be right and still be effectively wrong because it takes so long for you to be right. So we tend to use our data science processes not to predict returns, but to actually predict risk. Because the relationship of risk is much more stable and much easier to understand, right? If you're in a kind of growth regime, oftentimes, equities and bonds might be negatively correlated. And so we can use our models to predict, hey, how risky is this one portion of our portfolio going to be over the next quarter or 6 months? And then balance that risk off of another risk, which is unrelated to it, or maybe counterbalances it. So we're using our models in order to ingest, comprehend, and understand the different risks that exist in a globally diversified, globally invested portfolio, and then using data science in order to say, okay, how much of X should we hold to balance off the risk in Y, let's say.
Right. So you're using it kind of almost as a tool to show, or to show is the wrong word, but to look at what the different diversification strategies really are to balance out the risk. Is that fair?
Yeah, and a good simple concrete example is, let's say that we see that we're going to forecast what the volatility in our portfolio is, right? So as let's say 2020, COVID is a really easy example. It's a little bit of a gimme. Yeah, it's a good gimme. So as you see financial markets start to blow off, right? You see volatility start to ramp up, and also not only volatility, but everything starts to move together, right? International equities and domestic equities, which maybe used to trade in opposite directions sometimes, everything begins to trade together, right? And what you see historically when this happens is, oh, hey, everything's starting to go down and everything's going down together and markets are becoming more volatile. What can we expect? Doesn't take a genius to think, well, we can expect markets to be a bit more risky. And so we will use our models in order to say, okay, well, we know it's going to be more risky, but how much riskier is it than a typical period? And therefore, if we know how much riskier it is, how much cash should we take off the table, right? And so as financial markets are becoming more risky, volatility is increasing, we'll reduce our exposure. We'll actually take cash, like we'll take money off the table. And then we use those same models to forecast, hey, now we're through the worst of it. Markets have gotten a little bit more stable. We're forecasting lower volatility over the next few weeks, months, years. Let's start to reinvest now.
Right.
And so but one of the tools that we have will be this, AI model for forecasting volatility or forecasting the risk of a portfolio.
Interesting. Very interesting. What is your background?
Yeah, funny question. I followed a very non-linear path. So my original background was engineering. So I went to school here in Alberta for engineering, materials engineering with a specialization in nano and functional materials. I wanted to work on solar panels and build carbon nanotubes and all of that really exciting, cool stuff with graphene and everything.
Nerdy.
Yeah, and I loved it. I loved materials engineering. It's an intersection between, chemistry, physics, engineering, mathematics. But whenever I graduated, I decided that I didn't want to do research. And when I graduated, all of the good jobs were in, looking at pipeline cracks all day, which didn't sound very interesting. So I pivoted. I had self-taught software while still in university, and so I pivoted into software engineering right out of school, and ultimately wound up working at a energy technology company, and then working on kind of like big data SCADA systems, so monitoring cloud data warehouses and kind of real-time controls for SCADA devices, like field devices measuring and controlling kind of temperature, pressure, flow rates, artificial lift on oil and gas facilities all throughout North America. And kind of through that, started to get into the data science and AI space before, just well-timed. I got some great mentorship from data scientists that back in the day when they were still just called statisticians, kind of before Facebook really coined that term. So, a 20-year data science veterans before, data science was even called that. And started to understand, or it turns out that, whenever you have access to all of the kind of like raw production data going on in Alberta, or all the raw production data going on, you can start to play around with predicting what is going to be next month, right? If you know how much gas is being produced, well, maybe you can forecast demand on the gas pipeline downstream. So started to play around with some stuff like that, and you can maybe see the similarities between that and financial markets. So kind of went from that software engineering, data engineering, big data space, and then brought those skills to the financial sector with Viewpoint.
Interesting. Very interesting. What do you think from a skill set perspective is, maybe the one or two skills that help you be most effective in the role that you're doing?
Yeah, let me just take a moment to think about that. So I would break it down to a few different categories. Definitely, I mean, anyone who's been through STEM education often says the same thing, which is that, education, especially in STEM, isn't like knowledge being imparted upon you. It's giving you the confidence, the self-belief, and, the tool set in order to like acquire and apply knowledge for yourself. So obviously like that ability to be faced with a new problem, something you haven't seen before and you don't know how to do it, and not saying like, I don't know how to do it, I'm not going to work on it. Saying, I don't know how to do it, let's get started. So that kind of like confidence with comfort with uncertainty, I think is one, especially working in a, small, like initially like that small team, growing a business outside of the major hub. I'd say that's super important. Engineering teaches you how to break problems down, do the analysis. Software teaches you how to abstract, right? Cut through the noise to find the signal and really like what is the underlying representation. And then finance and investment management teaches you how to deal with risk and uncertainty. So kind of take those three key learnings: analysis, abstraction, and uncertainty and risk, and kind of put all of those together. And that's a little niche that I've carved out for myself in this world.
Interesting. Yeah, I assume that when they were looking to hire that role, there's not a list of 5,000 candidates in the country that kind of have the experience or the knowledge to be able to do a lot of that stuff. So that's very cool. Is Viewpoint, is it exempt market dealer licensed?
We are an exempt market dealer licensed, and we do have we have both like EMD, like OM funds, offering memorandum funds, as well as prospectus series. So we do have public mutual fund trusts as well.
Okay. I think you'll probably know the answer to this. If not, let me know and I'll kind of explain a little bit about it. But on the EMD side, one of my frustrations actually on the financial advisory world as well is that people don't understand that not every advisor can get you into all the products, right? So at the base level, there's the MFDA, which are mutual funds. You have kind of the next level up would be the IROC. They can do mutual funds, but they can also do individual stocks. And then you have the EMDs kind of on top of that, where they're able to do these what's called exempt market transactions, where you're using offering memorandums and whatnot. Can you maybe give the overview or talk about why an EMD is able to go into more products than, say, an MFDA or an IROC licensed individual?
Yeah, this is definitely outside of my expertise, so take this with a grain of salt. So we are an ICPM, so in our Independent Council of Portfolio Management. There is, in the independence channel, there's just more flexibility. So there's typically the different banks or institutions will have a shelf of approved product. And there's regulatory reasons for that. There's know your client, know your product.
Yeah.
The regulatory frameworks that surround these banks or these different independents, they're only going to approve certain products that they've done their due diligence on. I wouldn't necessarily frame that as a bad thing. As a small Canadian shop or a growing Canadian shop, like we have to overcome those hurdles through our own product, right?
Yeah.
Like we have our own private wealth management arm of the business where we have our own shelf, and we have to determine what makes it onto that shelf and what will we and won't we allow our advisors to sell. But then we have our own product that we then have to go to the RBCs and what have you and convince them to put our product on the shelf as well. And so there is constrained flexibility from there. I understand why it's there. It's there to protect it's ultimately there to protect the consumer and to protect the individual investor. But yeah, it'd be interesting to hear your perspective on that. And again, I'm a technology data science guy. I'm not the structure of financial regulatory markets.
Yeah, not the compliance officer.
No, she's probably going to disapprove this for.
Yeah, I mean, from a high level, my frustration actually with financial, I shouldn't say that. It's not all financial advisors, definitely. I think there's really good financial advisors out there, but one of my frustrations is that the public just doesn't know what they don't know. They don't know that they're not able to access some of these products because their advisor isn't licensed to be able to do that. And I don't think that the industry does a very good job of educating people on that, because why would they? Well, if you're an MFDA licensed person, why would you try to educate the public on what other options are out there? Because you're your advisor can't actually sell that product. So I think that's more the frustration that I see or that I have with the industry around that. Again, there's definitely reasons why you need those regulations in place. And I think our security system in Canada actually is quite strong compared to a lot of other countries. So
Yeah.
I think we've got good regulation. There's just not enough education to the average everyday person on what products there are because there's no incentive to teach them.
Yeah, and it's growing and it's getting better. I mean, the movement away from kind of transactional. So it used to be like anytime that you wanted to buy a mutual fund, there'd be a 2% loading fee, right? And so you would pay $100 to buy, $100 worth of this mutual fund, and you would pay 2% in fees kind of upfront. And that created incentives for financial advisors to get you to make as many transactions as possible because that's how they got paid, and they would get paid trailers for keeping you in that. And so there's just or fees to get in, fees to get out. And we've moved away from that as an industry towards fee for service, which was, you pay a flat management fee on your account, which was kind of what the high net worth space had been doing for a while before that became much more standardized in the retail space, which is better, right? But it still doesn't get away from this kind of fundamental tension in the investment management industry, which is just about alignment, right? And at the end of the day, like your tension with financial advisors, right? There's some that are great, there's others that aren't. And my perspective on this is that to be a successful financial advisor is much less about your ability to manage money as it is your ability to build a personal brand, to sell, and to showcase the idea of somebody who should be managing your money, right? To showcase like your own financial success and all of those different things. And so a lot of the good financial advisors are the ones that have a love affair with portfolio management itself and almost do it because they care and because they love it, not necessarily because it makes them more money. Because the reality is, if they wanted to make more money, they should just market and sell, and the public doesn't have the knowledge to understand like good versus bad. There's not really a ratemyfinancialadvisor.com. Maybe we should make that.
Good idea. Yeah, good idea. That's funny. That's good. So what's next for you guys? What's next for you? What's on the horizon for you coming up?
Yeah, so as a business, we've been focusing. So we only did launch our kind of public prospectus fund. So again, like our story has really been starting in the, family office, ultra high net worth space, because you can have a small team and you can gather scale quickly, right? And our goal has always been to bring this broad to the masses, to everyone from institutions to retail. So we've got our prospectus funds now. We've been really focusing on marketing those into financial advisors, right, and to retail clients, but primarily through wholesaling through financial advisors, and getting kind of that institutional investment strategy into more people's hands. That's been our big focus. And as well, we're launching, our own private investment accounts, our own private wealth management business as well. We're getting that starting early discussions to get that started. And really focusing on giving that more individualized investment advice, right? Rather than selling to an advisor, selling to an individual client and saying, hey, we'll actually build you your own investment portfolio. We'll be one of those good financial advisors that do that, or find those good financial advisors that do have that labor of love that goes into their craftsmanship. And, they don't just care about building the biggest book and attracting clients, but actually care about, the call it intellectual pursuits of investment management alongside, of course, the business pursuits.
Yeah. No, that's awesome. If somebody wanted to learn more about the company, maybe look at some of these investment opportunities, or reach out to yourself and connect with you, where would they go for all that?
Yeah, so our website, viewpointinvestment.ca, you can just search Viewpoint Investment Partners. If you're outside of Calgary, maybe Viewpoint Investment Partners Calgary. Not sure how good our SEO optimization or our SEO is. But yeah, Viewpoint Investment Partners is the company. We've got some investor education resources on there as well. And then for me personally, LinkedIn is my preferred. Benjamin Reeves is my LinkedIn name, and search me up. Feel free to connect. Let me know how you heard. And yeah, I'm always happy to grab a virtual or in-person coffee in Calgary.
Awesome. Certainly appreciate your time here and your insights into all that. Sounds like you guys are doing some pretty cool stuff, and I certainly commend you because again, I think this is something that's needed, and the US has done a much better job of doing these types of products than Canada has. So good for you guys on that.
Yeah, we're trying to bring innovation into liquid financial markets in Canada and try to do it out of Calgary, Alberta.
Awesome. Well, again, thanks, Ben, and really enjoyed the chat today.
Awesome. Thanks, Matt. Thanks for having me on. It's been great.
You've been listening to Beyond Wealth, Success Unscripted with Matt Calnan. Want to be our next guest? Visit beyondwealthpodcast.ca/guest. See you on the next episode.